All right, in this lesson, we're going to go over some other issues that might come up when it comes to the equity method. Let's start first with reporting a change to equity method. So thinking about it this way, we take a 10% stake in an organization. We don't have control or influence of that investee. Later on, we decide, hey, we're going to up our ante to 25%. Therefore, that says we need to change all of our books to the equity method. GAAP says this: when we are reporting a change from non-equity method or the fair value method to the equity method, we retroactively adjust as if they had always used the equity method to start with. Okay, so this can be a little bit dicey because we're going to have to go back all the way to when they started and almost like reverse all of those entries and then put back all of the journal entries that we learned in the journal entry lesson for equity method. Okay, so the one thing here to note is that if we did start with 10%, okay, and then 3 years down the road we anteed it up another 15% to 25%, when we do the equity method, we assume we had 10% investment all the way to the point in which we had 25%. So normally if we own 10%, we wouldn't even have to do these equity method journal entries, but now that we do have 25%, we have to go back into the journal entries as if, retroactively, as if we had already always used the equity method. We would still use the same percentages. It just means we'd have to go back and redo those entries so that we can bring it all the way up to date. And it looks like that our financial statements look as if we always had used equity method. Now, whether or not you need to report this as a retroactive adjustment, that's going to be based on if you're a public or private entity, okay? And whether or not it's material. The other issue that you might come up with the equity method is reporting investee losses. We talked about how to report them, so we're going to report the losses on our investment when they occur. However, if there is a permanent decline in the value of the investee, we may need to take an impairment loss or recognize an impairment loss for the decline. So if we have on our books that our investee is worth $1 million, and based on their missteps or judgment calls, and it's now our share is now worth $500,000 instead of $1 million, we might have to take an impairment loss. Now the key word here is that it has to be a permanent decline in the value of the investee. It cannot be temporary in nature, and that is a judgment call for a CPA or an accountant to make, whether or not there was a temporary decline in the value of the investee or is there a permanent. If it's temporary in nature, which means we're going to go through, we have a drop here, but we know that it can come back up, then we don't make the adjustment. Okay, so that's one thing to really note. Don't make the adjustment unless it's permanent in nature, and it will continue to be permanent nature for the foreseeable future. Now, what happens if an investment account goes to zero because of the investee's losses? One thing to note is we discontinue the equity method. We never really want to have a negative balance, so you would discontinue the equity method on the balance sheet, and then on a report or an Excel, you would keep track of those continuing losses. So you would make them negative in your books or in a separate book, okay? And then it goes back to positive once we've recaptured all the unrecognized losses. So let's say that our books show zero, but in our documentation that we've kept over the years, it's at negative $150,000, okay? Until they can get us back to zero, we will continue to put zero. So next year they have a positive, even though our books say zero, they will continue to say zero. And then let's say 2 years down the line, they've already made $200,000 from the point where it was at its lowest. So now we've recouped the $150,000, we're back at zero, no gain, and then we report $50,000 in positive investment for that investee. So that's one thing to note. We go down to zero, don't report anything else, and then keep track on a separate note or something separate, all the losses continuing to grow, and then when the positive starts coming, we get to zero. We still don't report anything on our financial statements, and then when it passes zero, which means that it's recouped its losses, then we will recoup and put the positive effect on our investment in the investee. Okay, third thing, reporting a sale under the equity method. Just a couple of things here. There's really not a big thing to think about, but when we're reporting a sale of an equity method investment, we got to do everything that we would do for depreciation, selling an asset. Okay, when we sell an asset, we bring depreciation up to date, and then we report the sale, booking our gains or losses. Kind of the same thing here with the equity method. We bring the investment account up to date, so we need to figure out from our investee up and from the beginning of the year all the way to today. So let's say today's May 15th, from January 1st to May 15th, what was your net income or loss? They might say, okay, my net income is this. Do you expect any dividends? What are your dividends? Then we bring the numbers up to date. Once we brought them up to date, then we'll record the disposition of the investment. So just like depreciation, if we are disposing of our asset on May 15th, we bring depreciation from January 1st all the way through May 15th to the asset. So we're bringing the asset up to date, and then we would record this disposition of the asset, booking the gains or the losses. So that's the equity method when we're selling our equity investment. Equity method investment, then we need to bring it up to date and then dispose of the investment. All right. Kind of unrelated to these, but also sort of related to this, is this idea of deferral of unrealized profits in inventory, what I like to call intra-company transactions. Under consolidation, and remember, consolidation is like me as a corporation, as an investor. I own the investee. Let's assume that it's a sub of mine, which means I own everything of theirs. So if there's a transaction between me and the investee, that transaction is null and void, so we reverse it out at the end of the year until that investee sells that inventory to a third party, because I might be giving them favorable terms, therefore making my income statement better or worse than if I sold it to a third party. So one thing to know, when I'm consolidating, we remove all the intra-company transactions or journal entries, and we assume that both entities' transactions are one. Same thing here with the equity method. So let's assume that I, as the investor, sells inventory to the investees. I defer the gain until that investee sells it to someone else. Now, if they use it, then we're going to have to do some intercompany transactions there. We're going to assume that I sell it to them, they sell it to someone else for these examples. So I sell it to them, they hold it, and then they sell all of it. Then we would book it once they've sold all of it. Okay? Now, there's two things to understand when it comes to selling inventory to and from. We have something called downstream. Downstream means me, the investor, the big bad investor up at the top, sells to the investee, the small investee at the bottom. That makes sense, right? Top to bottom, downstream. Inventories coming from the top to the bottom. The other one is called upstream. Upstream is when the investee sells to the investor, so it's going up. Now, the reason why we're teaching you this is because in a different chapter, when we're talking about the consolidations, they work a little bit differently here. So we want to get you understanding downstream and upstream before we get there. But at the end of the day, equity method, same procedures here. Now, we defer the gains or losses until it's sold to a third party. That's kind of the easiest way to think about this. When they sell it to a third party, then we can book it. So let me give you a quick example of how this works. Let's assume we have an upstream, so the investee sells to the investor $100,000 worth of goods. Okay, the investor then sells out to their customers. They've sold $90,000 of the $100,000. Therefore, at the end of the year, we have $10,000 of inventory still left in the investor's possession. Okay, we've already sold it to a third party. Therefore, we would book all the gains that were associated with this $90,000. But this $10,000, let's say their net profit margin is 20%. So we are going to defer $2,000 of gains until they sell it to their customer. So very simple example. There's more examples in the book, but I wanted to give you an idea of how we do deferral of unrealized profits when it comes to inventory. So those are the things that you might see and other issues when it comes to the equity method.